Well, Marriott International reporting better than expected earnings for the fourth quarter, but a miss on revenue and lower than expected profit guidance is overshadowing the beat on the bottom line. Shares of Marriott, MAR is the ticker symbol there. They're down by about 4.7%. Here to discuss, we've got Baird's Senior Research Analyst, Michael Bellisario. Michael, great to have you here with us today. First and foremost, I want to get your read through on this report and what investors perhaps are sour on within this particular print.
Thanks. Good morning. I think the big thing, you think about the market being down 1% and Marriott's 2024 EPS guidance being about 3% below street expectations. You add that together, it's 4%. That's kind of roughly what the stock is down. So not totally surprised to see the stock weaker. I think when you peel back all the moving pieces that they had with a bunch of different line items in the fourth quarter, underlying trends are somewhere between good to still pretty darn solid. We like to say people are traveling. They're just traveling to different markets on different days of the weeks for different purposes. So travel is still strong. And really some of the weakness just has to do with expectations, the stock being at an all-time high and 27 times earnings leading up to the print.
So, Michael, when you sort of divvy up the pie in terms of the expectations that the markets had going into this versus some of the fundamental subsectors of what you're seeing within the actual business, where do you think that balance lies?
Well, there's some questions around leisure travel and still the sustainability of demand there, especially given all the headlines. But leisure demand remains solid in the aggregate. That's the best performing customer segment, albeit growth there is the slowest. Where you're seeing the recovery still unfold is Asia, China in particular. And then in the U.S., urban markets, group convention business is still pretty strong. Companies are spending money. You're probably traveling a little bit less for the one-day trip, and you're seeing more of this group and small meeting demand, and that's really robust, and that's benefiting Marriott's portfolio.
Yeah, that's a great point. And we were speaking with the Hilton CEO, Chris Nassetta, about that last week, that business transient is how they classify it, the biggest segment of their business, and particularly where he expects that to strengthen. Is that something that you expect to be a rising tide for the overall industry? And who is the kind of largest winner in that particular rebound in corporate travel, especially as we're kind of looking across the margins that would then trickle back through to some of the accommodation space?
Well, business travel historically has been the biggest contributor to hotel profitability. It's a little bit smaller now because leisure has gotten bigger and business is still recovering. But think about when someone's traveling on a corporate expense. You're a bit of a price taker. You book 1 day, 3 days, 5 days ahead of time, and you go to the city you're going to because you have to. So it's highly profitable business. And business travel, the expectation is that it will continue to steadily recover. And Marriott benefits from that. Marriott, compared to some of the other global hotel brand peers, more hotels in urban gateway markets, more bigger box convention and group-centric hotels too. So they're poised to benefit and capture a disproportionate share of that demand as it continues to recover in 24.
So, Michael, when you do compare Marriott to some of its peers then, are there perhaps more attractive hotel brands that you like?
So we're neutral rated on Marriott. We're outperform on Hilton. Really, when you take a step back, the two businesses are very similar. When you talk to industry participants, it's really 1A and 1B in the industry and everyone else. Some people will say Hilton, Marriott. Other people will say Marriott, Hilton. We like to pick one of them because we have to give something to our investors to pick from. But really, they're very similar. And if there is any difference, Marriott's a little bit more urban, a little bit more group-centric. There's a little bit more operating leverage in Marriott's model versus Hilton, but very similar. And then we also cover Choice and Wyndham and Hyatt. Those are more mid-cap names. Particularly Wyndham and Choice are focused on the lower end chain scales, which is interesting because Hilton and Marriott and Hyatt have introduced new conversion and new build mid-scale brands, and Hilton's introduced premium economy. So they're going to where the white space is, that is Marriott, Hilton, and Hyatt are, and that's benefiting their growth rates as well.
Is there any read-through that we can extrapolate from Marriott earnings today, Hilton earnings last week, that can prepare us for Airbnb when they report?
Well, Airbnb is predominantly leisure focused, and leisure trends are still solid, but the growth rate is what has slowed. For Airbnb, it's sort of the Kleenex and Xerox, right? It's the global brand that everyone knows. You Airbnb it, and it's about a total addressable market for them, and continuing to grow their share globally. But their growth rates will be dictated by the leisure traveler, and what you see from Hilton and Marriott is cross-border, international, business, and group is what is growing faster than leisure. And some of that is simply just normalizing post-pandemic trends. And that's what we've seen recently from Airbnb, and that's what you should expect to continue.
And Michael, as we continue to look at some of these post-pandemic trends, obviously we still have that pent-up travel demand. Most of that seems to be out of the way then. So what is really the driving force here going forward?
Well, for the stocks in particular, net unit growth is, at least on a normalized basis, will be growing faster than RevPAR growth. The public market has really valued net unit growth. The consistency there, Hilton and Marriott, for example, the majority of their net unit growth is new construction. If something is in the ground and being built, it will almost certainly deliver this year, next year, the following year. So the public market can look out a couple of years and ascribe a pretty robust multiple to that piece of business. And that's what's changed compared to 7-8 years ago when net unit growth was lower. Marriott's global share is 7%, and it's in the teens in the US. So it's not as if they're bumping up against obstacles in terms of growth, but really the white space for them is international, and then the net unit growth and the consistency there and the acceleration off of the lows that we saw in 22 and 23 is what is really going to drive the stock. But we said this in our preview notes last week. Expectations were high. Both Hilton and Marriott were essentially at all-time highs leading up to the prints. The stocks were up in a straight line over the last 3 months, and both of them were trading in the high 20s, nearly 30 times earnings. You sort of needed perfect reports and better than expected updates, and we didn't necessarily get that from either of them.
Yeah, tough to get better than expected. Appreciate you joining us with your insights. Michael Bellisario, thank you so much.
Thank you.